Welcome to the show, everybody. We have another great show for you today. Today's topic is going to be the 5 types of capital we're looking at when trying to finance and fund internal growth. I am your host, Adam, with Besim here on the show. We want to get started right away. We're going to throw in a couple bonuses, so definitely stay through to the end of the show. And it's going to be a really nice broad spectrum coverage of the types of financing and capital that a lot of businesses are seeking. So, Besim, if you are ready, we can just jump
I'm ready.
right
This
into
is
it.
going to be great. I think it's going to be really interesting because a lot of the types of capital that we're going to talk about, they're used in specific parts of the business cycle, the business growth. And so I think as people kind of going through different parts of their business, they'll be kind of using some of the types of capital a little bit more than the other ones. And so, we're going to kind of show you or talk about things that you can use in different types. So why don't we go ahead and get started, Adam? What's the first one that
Number one, let's talk about private capital, shall we? We're talking about, what do we mean with private capital? Capital maybe from friends and family members to help fund startup and growth of a company. That's number one.
Yeah, I mean, when people are starting off their company, it's difficult for them to get financing a lot because they don't have that track record of history. And so really you're going to need to be relying on people that are either have some kind of a vested interest in seeing you succeed, which are your friends or your family. A lot of times those are people that kind of know a lot about you. They have a belief in you that you're going to be successful. And so they're willing to put their money up to help you. Sometimes they're doing it from a philanthropic perspective, but a lot of times they really believe in you, that they want to help you out. And so that's the best. And a lot of times ends up being the cheapest. Some friends and some family, they'll want a piece of the business as well, which can get expensive.
Sure.
But generally friends and family are where most people kind of start, their own savings or friends and family.
Some of the benefits of that obviously is you're not going through the process and processes that you might at a financial institution, a bank, a larger company. So generally speaking, cash to close is very fast in those situations. Hey, can I get $1 million to start? Sure. Let's draft up some agreement and be done with it. Right. So not as much of the double checking. That's a bonus. Also, you probably can get, I use this with air quote, a good rate on the deal, right? I mean, I know you've worked on deals, I have as well, where let's say someone's father has put in a good chunk of money into the business and rates pretty thin, if there are rates at all, probably with some of the debt able to be completely forgiven over time.
That's what I was going to say. Yeah, you see a lot of people that get money from like their dad and they don't have to pay anything back. I think famously, the president, Donald Trump.
Small loan, $1 million.
Small loan of $1 million to get started. So if we got that kind of backing, that's great.
I'd take that loan.
Everybody doesn't always have that, so they got to kind of get it from multiple people. But I mean, if you have that available to you, it's always a good place to start.
Right. And it's win-win. Those that are investing are definitely, they're betting on your success. So they want to see you succeed, and they fully probably intend to get paid back with some interest. That also kind of speaks to the con of or some of the cons of this type of lending is that there could be future lump sums due. So if you are going to be successful and you are going to grow, you have to do so in a pretty specific window from time to time in order to pay that loan. And then one last con I want to talk about before we move on is potential subordination issues with that type of lending too. So when a bank looks at that type of leverage and debt on a balance sheet, oftentimes we'll want that debt to be junior to any type of senior financial lending too.
Yeah,
So
another
something to
thing I would
consider.
just mention too, is since you brought it up, a lot of times when you get this kind of debt, it's not well defined as kind of the repayment terms, what the expectations are. You'll get a loan from somebody and they'll say, here's money to kind of start your business. Just pay me back when you can, or pay me back without any interest. And then, if your business does really well, there seems to be an expectation sometimes that you're going to like help give them a little bit of that upside. On the converse, if you end up, not performing well, sometimes there's an expectation that, you're going to figure a way out to pay them back regardless. And so I think if you are going to get friends and family money, just make sure that you're very clear in the terms, what the expectations are from both parties, and make sure that you're okay with that, so that further on down the line, you're not having an issue where you're damaging, what could be really important relationships to your life because you haven't fully discussed kind of the upside, the downside, and how things are going to be played out.
Exactly. No, that's very good points. Let's move on to number two. So let's say you don't want to leverage friends and family, but you have a decent personal backing of assets and wealth. Let's talk about private wealth lending.
Yeah, I mean, private wealth lending kind of like, again, I think it goes back to the time in your business cycle. If you're new in business, or relatively new, let's say you have a year or two under your belt, there are private investors who maybe have, they may be part of a family office where they're managing a lot of wealth that their family's accumulated over the years, and they look to grow that wealth by investing in newer businesses, maybe riskier businesses, or businesses that banks are not willing to invest in because they're willing to take that risk, but for an outsized return. So generally, this money doesn't come with some of the structure behind bank lending, but it does come with a lot of strings and can be quite expensive because generally you're giving up some sort of equity piece when you're getting that money. So just be cognizant of that. It seems not like a big deal to give up, 10% of your business when you're not making anything. But if 5 years, you fast forward 5 years down the line, that 10% could be worth quite a bit. And
Mhm.
so, but that's generally how it works. I mean, what would your comments be on the kind of the
Yeah,
base?
no, that's a good point, especially when you're talking about ownership percentage early on. That scale might not seem significant, but if there is success and growth, that's a lot of money that's missed up on it. And the other side of the coin is too, for private wealth lending, and there's a lot of options from lines of credit to this, that, and the other. Is you do tie up your assets; those are going to be pledged as collateral against that type of lending. So if it is something where there's a hard liquidity position, i.e. cash or even stocks and bonds that's in your portfolio, to obtain that type of lending, those assets are in many instances fully pledged or mostly pledged against that. So just know that if there is a windfall of liquidity personally, that will be what is used to back the loan. So for the life of that loan, those assets are tied up for all intents and purposes.
Yeah, I mean, one other thing I would kind of mention on these last two types of capital is that, these there's a lot of free form in these. There's a lot of differences in the terms, regardless of where you're getting it from, because it's private money and people kind of do whatever they want with it.
Right.
And so they can kind of put whatever terms they want with it. So
Hmm.
there are certain families or certain groups, private investors that are looking for certain types of deals, certain types of equity, things like that. And so they'll put certain parameters around it. So just
Right.
be aware that, you'll see a lot of things that maybe you haven't heard of or not familiar with, or maybe wanting certain types of
Hmm.
uh, arrangements in order for people to give you money. A lot of times people are wanting board positions on the company and things like that, just to make sure that the management goes well. A lot of times they get involved in management, especially if it's private wealth coming in, because they want to really accelerate it. And another thing you should also think about is a lot of times private investors, they have an exit in mind, and their exit in mind might not be at the same time frame, pace, or scale that you want to exit in. So just kind of have those things in the back of your mind as you're talking to private investors. And there's a lot of room for negotiation in these types of situations. So if there's
Right.
something that you don't like, you can feel free to talk, because there's really one organization or one private person making the decision. When you get to something more like bank lending or some of the other stuff we're going to talk about, there's regulations involved,
Yep.
there's credit policies, there's things that are
Yeah.
out there that are
It's a
governing.
lot less uniform, right? I mean,
Yeah.
it's
Yeah.
whatever flavor and style they want to throw at the deal that benefits both sides, but them in particular. So you
Yeah.
can't compare one institution to the other when it comes to that.
Yeah, exactly. All right.
All right,
What's
let's move on to number three. So we talked about private money, private wealth money. Let's assume a business is still early on in the life cycle, or maybe doesn't quite still yet qualify for traditional bank lending. Let's talk about the SBA. That's a good option for a lot of clients that we find, and it has its pluses, it has its minuses too.
Yeah, I mean, the SBA is great. So basically, the Small Business Administration is funded by the government. The main
To a
thing
degree.
the SBA is
Yeah.
trying to do is grow jobs. And so what they're interested in is helping companies grow so that they can hire new people and grow the economy. And so actually, the SBA has been a pretty successful program, and it actually funds itself by the fees that it charges and the interest that it earns. The SBA is interesting because they've got basically two major programs. So there's actually other programs as well, but there's really two major programs. It's the 504 program and the 7A program. which companies really use to get access to capital. And so how the SBA works is the SBA will guarantee a portion of the debt to the bank. So if the bank is lending you $1 million, the SBA will they'll guarantee.
75, 80%. So usually like 750,000, maybe
Yeah, I
800,000 of
think the
that debt
highest they go
on
is
average.
90% on some situations, but they go on some as low as 50%, right? So it
Mhm.
depends. And then what happens is the bank will basically mitigate one of its issues with your loan, or maybe a couple of issues with your loan, with the fact that they're getting an SBA guarantee.
Right. It's a
So
credit enhancement, right? From the
yes,
bank's standpoint, a bank always views a loan as a probability of default or a loss given default. Should
mhm.
there be fault or loss with an SBA loan, you're right. It's absolutely mitigated by the fact that there could be 75, 80, whatever percent guaranteed by the government. So it makes the bank feel a lot more comfortable because the bank in this instance is acting more as a broker of the deal. The bank will carry the note, but it's funded and processed and everything by the government, by the SBA.
Feels like the loss given default, which is certain banks look at that more than other banks, but the loss given default is in the case that you actually, the loan goes bad, how much money is the bank going to lose? And if you have an SBA guarantee, then the bank knows they're not going to lose more than X. And maybe they won't even lose that depending on what the
Mm-hmm.
collateral base is.
Yep.
Like we said before, there's really two SBA types. There's the 504 and the 7A. The 504 is generally used for real estate purchases. Now, how that works is the bank will come in, they'll allow up to 90% of loan to value, and the bank will come in, and they'll also allow up to 25 years. The bank will come in and make the loan, and then the SBA will buy off 40% of that loan. So the bank is, 40% of the loan. So the bank is then left with a 50% loan to value. So they have a really good loan to value plus a piece of property that is securing the loan. So that's why the bank's willing to do that. On the 7A, it's basically the bank gives you a loan, and depending on the situation, the SBA is guaranteeing either 75% or 90% of the loan value. So if you have $1 million loan, it's generally 75%, but in some cases it's 90. But generally, let's say you have a loan for $1 million. Well, the SBA is going to guarantee 75% against the loss. So I've used this in business acquisition before, where companies bought another company. There was not enough collateral in the deal. And so basically what happens is then if there's a default, the bank will get 75% of their loss refunded by the SBA. And that's how it works. So they're willing to do a lot more things, but there's a lot of strings involved with SBA. There's personal guarantee issues that could arise. Like, for example, if you have real estate property, rental real estate, you will have to pledge all of that as excess collateral.
Potentially,
You'll
yeah.
have to get appraisals with it. It becomes expensive. But basically, at the end of the day, there's some terms and some benefits to doing an SBA deal.
Right.
You don't have to be in business as long. You can have lacking in collateral, but you still need to be making money. So don't go into a deal thinking that because you're losing money, they can just slap an SBA guarantee on it. It generally helps against not enough collateral or fixing terms that the bank's not willing to give, like going 25 years on a real estate note when banks don't want to go more than
Keep
50.
in mind, going through a process like this is probably one of the longer time frame projects that we have here compared to either bank financing, private wealth, and so on and so forth. There's a lot, I'd say, an excess amount of due diligence compared to traditional lending when it comes to SBA. So the timetables are often very different. We did a deal this year where I believe, correct me if I'm wrong, the relationship manager was working on the SBA deal for the better part of a year. Now that's one extreme, and I'm certainly not saying they take a year, but you can run into hiccups along the way because there's a vast difference between bank requirements and small business administration requirements, and oftentimes they need to marry or come to some sort of agreement before closing. So just know that timetables are definitely longer for
Yeah,
SBA.
definitely. I mean, you're really not going to get an SBA deal done in less than 60 days, even
No,
if everything goes pretty
no,
smoothly. So
yeah,
just know, like, if you think a real estate deal can get done in 30 to 40 days, when everything is smooth, SBA deals not getting done between 60 and 90 days, because you're going to have to add a lot more process to that, a lot more documentation, a lot more due
Right.
diligence. The government asks for a lot of documentation.
Hmm. Yeah.
Anyways, okay, we're gonna do a whole separate podcast just on SBA lending, so you can get a better idea. And we're even going to bring in someone that's worked in the SBA as a lending officer for like over a decade, and he's got some great information as well.
Okay, number four, we're going to talk specifically as it pertains to vendor financing. So this is going direct to vendor to obtain financing for equipment and otherwise. And what are the benefits and drawbacks of going direct to vendor before you go to the bank?
I mean, I think the number one benefit that I see is that vendors typically do not do as rigorous of a credit underwriting.
Hmm.
So like I've had a lot of vendors reach out to me as a banker for my clients looking to give my clients some kind of vendor financing. A lot of times all they're asking for is the account in good standing? How much money do they have in their bank account, and how long have they been working with you? And, a lot of times they're not even providing financial information. It's just, I mean, sometimes if you're just doing business with someone for a few months and you've been paying them, they'll give you a line of credit, for their stuff. And the reason they can do that, and we had talked about this a little bit earlier, is because, they're not making interest on, they're also making profit because they're able to sell more product to you. So a bank might make 2%, 3% on some loan. Well, they're selling you product that they might be able to get a 30, 40% margin on. So they have an incentive to get that to you. And as long as they feel pretty confident that they're going to get their money back, then they'll do that. So it's pretty easy to get. You can also get it at a lot of different vendors at one time. So I had a client that was having trouble getting bank financing because of their industry and some other stuff. And he was able to get vendor financing at 3 or 4 places. And he had almost $1 million in vendor financing, which is, it's pretty significant and really helped his
Hmm.
working capital cycle.
Right.
I don't know. What are some other thoughts that you have on the vendor?
Yeah, no, the vendor financing, and that's where the cost of that capital can vary greatly. Oftentimes, we'll see vendors with very competitive pricing to bank equipment type lending and whatnot, but yeah, they can also be on the higher end. Keep in mind, they also have a vested interest in not just lending and allowing you to obtain this financing for equipment and otherwise. They also know their collateral very well. Whereas banks, and we'll talk about banks next specifically, our focus and our purview is not on collateral lending. Collateral lending or the collateral serves, merely as a backstop to the loan, but it's not our primary
Yeah.
source. Vendors, they know their product very well, and as we talked about earlier, when it comes to a potential loss or lack of payment, should they need to repo and so on and so forth, they know that market extremely well. And if they need to turn that again on the resale market, they know what they can get with that.
Yeah, exactly. And there's also another thing I would mention on the vendor financing. A lot of times the transparency of what you're getting, actually paying, might not be there
Correct.
because they might hide some of that financing cost in the actual cost of the equipment or the cost of the thing that you're buying, or they
Mhm.
might, have the rate be higher, but then actually reduce the prices of the equipment to make it look more attractive. They can play with the numbers in a few different ways. It's just like when you go buy a car. You go to buy a car and they're playing all kinds of games with the vendor, with the dealer financing.
Yeah.
It's similar with vendor financing. I mean, they're gonna do what's gonna make them money, so they might adjust the price up or down of the actual equipment or the actual product or whatever it is.
Right.
So there's not quite the transparency there. But if you're a new business getting up there and you need to get access to capital, I actually think this is one of the better ways to get access to
Mhm.
capital because it's something that people don't talk about quite a lot, but it's actually a little bit easier to get qualified for.
Right. Yeah, yeah. You bring up a great point. We're talking about hard versus soft cost, on the deals,
Yeah.
and definitely there's ways to finesse those numbers. That's a nice way of putting it. All right, let's move on, shall we, to number five. And
Okay.
here we come to the most traditional sense of capital access, and that is bank financing. So now we're talking about big box bank, regional bank, small community bank. So you're going to an actual financial institution and speaking with a relationship manager, a bank or otherwise, and you're looking for a capital injection into your business.
The cheapest debt that you're going to get is from traditional bank financing. Okay. But because it's the cheapest, generally it needs to be the least risky. And so you need to qualify for bank financing. You have to be in a good financial position. Like everybody's heard uh, the expression that a banker will only lend you money when you don't need it, or they'll give you an umbrella when it's not raining or something like that. Well, the reason is because if banks only make 2 to 3%, maybe less on the money that they're lending you. And so if one deal goes bad, they have to do maybe 20, 30 comparable deals just to replace their loss. And so they've got to be 99.9% sure that your deal is not going to go bad. And so in order to do that, they do a lot of scrutiny on the deal. They have a structure and a framework, which they call a credit policy, which dictates how they are going to actually lend you money. And during that process, they write that out, they give it to regulators, and any deviation from that policy has to be well documented and explained.
And
And so,
justified.
yeah, it has to be well justified. And so, credit clients, I mean, banks, when they're talking to their credit clients, they got to kind of fit them within that framework. And deviations, even though they can occur, have to be well documented. But the whole idea is to reduce the amount of risk so that they can provide capital at a low rate. Because whether you make tens of millions of dollars or you lose money, they're only getting paid back there like a couple of percent. And so that's why it's really cheap. Most people, they like to use bank financing, as much as they can to kind of finance their business, because it helps them leverage and kind of grow the business in a quick fashion. It's cheaper, but it's also the hardest. I won't say hardest to get, but it's more
Right.
complicated to get because you got to fit in these
Sure.
boxes.
And typically we don't see businesses with a real propensity for growth without some sort of capital injection. Every business comes to this crossroads where they've grown as much as they can. And if you want to get to that next echelon, that next tier, there will need to be a capital injection. And why that's important is, as Besim said, it's the cheapest form of capital. And then two, you're not tying up your capital, so you can deploy your capital to reinvest in the business and otherwise. So you can get kind of a growth injection two ways: organically via the internal growth and retained earnings of the business, and then two, with bank capital. And another reason this is also very attractive outside of the cost is when it comes to the success and the future growth of the business, all profit is yours. We're not talking about any bank ownership interest in the company, like we were earlier with private wealth, where early on you might give up a percentage and it might not seem like that much, but as you grow exponentially, that becomes a big number. The bank has no financial vested interest in your profits going forward. They all go to you, but that can't start without the capital injection from the bank.
Sure. Well, okay. I think those are like the five big pieces. Let's give them a couple of bonus ones here. Let's talk about some types of financing that are available, but they're not really traditional bank lending. Like let's the first
Yep.
one that kind of comes to mind is like asset-based lending, not
Asset-based
from
lending.
non-traditional bank. Tell us a little bit
Right.
about that, Adam. How does it work and what is it?
Sure. Asset-based lending. So if you kind of want to take a tangent off of bank lending looking particularly at your financial performance and how it's been historically to project future, debt needs and so on and so forth. We have asset-based lending, which is largely based, or I should say, kind of equally based, not just in cash flow, but on the collateral side of the house. We see this a lot with companies and institutions that are heavy in receivables, but specifically high in inventory asset. Traditional bank lending and lending in general will cap those amounts. Inventory, when we see inventory exponentially higher than receivables, your base of assets is greatly reduced. Inventory will never outpace assets, but that's when a product like an asset-based lending really comes into focus. Yes, there still has to be a degree of cash flow and profitability to the business, but the other side of the coin is there's a real close attention paid to the collateral of the company, ARs, and
Sure.
specifically inventory, where there will be field audits, field exams on the quality of the assets and so on and so forth, so that there can be a decision. What we'll find with asset-based lending specifically, let's just talk about lines of credit, where a line of credit is really limited by the receivable and inventory base. We can have a much higher line capability when we go to more the asset-based product. We're talking $5 million plus
Yeah.
lines where there's a very heavy reliance on the collateral.
Yeah, and so you'll see kind of different organizations doing asset-based lending as well. So like major banks will do asset-based lending, and they're typically doing that for larger loans amounts where the collateral is very strong. And actually, in some of those instances, the rates will be significantly lower than just traditional bank lending because the collateral is so long, so good, and they still have some kind of guardrails as far as the profitability. You're still going to be needing to make money, but you have other asset-based lenders that are non-traditional, that are not bank lenders, and those guys will be willing to even lend on deals where the company is losing money, but they'll just look at the assets and say, okay, well, we're going to give this much advance on those particular assets because the people that are the accounts receivable is strong. There's a lot of great companies on there. The inventory is strong. And so those guys are actually pretty expensive. I mean, you're talking about double digit interest rates on there, 10, 15%, where, asset-based lenders in the bank, the company's already doing well, but this will give you a little bit more access to capital because they're looking not just at profitability and cash flow, but also at the asset base. And so it's kind of interesting because they both kind of use a similar way of underwriting, but one is kind of for one extreme and the others for the other in a little bit. But what's another bonus? You have any other kind of
Yeah,
bonus?
let's talk about mezzanine financing. So you want to talk about expensive financing. Well, this is an option. I always equate this kind of like to the Shark Tank, Shark Tank on NBC, where you go and you pitch your company, your product, or otherwise, and they're willing to give you $200,000 so long as you give up 20% of your company and pay a premium. Now, there's a lot of pluses and minuses, but it's another bonus financing. I've seen it multiple times, and we're talking potentially the high teens for the rate. Why is that?
So, when it comes to mezzanine financing, one thing that's really important to understand is that typically there is other debt in the situation there. And so you might have some bank debt, you might have mezz debt, and you might have personal debt all in a capital structure. And what the mezz debt is doing is it's taking taking a second lien position to the primary debt. So for example, I worked on a deal earlier this year. The company wanted about 50 million in debt, but the bank as a senior lender was only willing to offer a little bit less than 20 million. So they were able to get some seller financing, which was because they were doing an acquisition.
Yeah,
But
like a seller buyback note or a
but
whole
there in
lot.
the middle, they had needed something to kind of bridge the gap. And so what they do there is they have another tranche of debt, which is mezzanine debt. And what that does is basically it comes in, it takes a second lien position behind the bank. So if everything goes bad, all the assets get sold, the bank's getting paid back first, and whatever's left over is going to go to the mezz debt. So that's one of the reasons it's more expensive because they have a higher risk of loss. But that mezz debt is typically also has some warrants in there as well, where they're like getting a small percentage of the business. And so
Yes.
that mezz debt then eventually gets structured out. And so the idea is, this particular company, the idea was we do this capital structure, the company starts growing its EBITDA, then once the EBITDA grows to a certain point, they qualify for more senior debt financing, and they can take out the mezz debt. And so typically, this mezz debt is only for a short period of time, called a year, 2 years, kind of maybe max 3 years, something like that. And these are private lenders, but they're willing to take a backseat to the bank. And that's kind of one of the reasons why they're a little bit more expensive.
More
And they're
expensive.
expensive both from an interest rate perspective, but then also they generally want to get some kind of equity in the business and upside
Correct.
potential.
Yeah. With the end goal, it being a very short, no, I say relatively short turnaround where they get bought out.
Yeah.
That's what they're looking to do. So no, I agree with that. Let's go on to private equity. So
Mhm.
here we're talking about investor pools and so on and so forth that might be interested in certain businesses, certain
Yeah.
industries. Why are we going to consider private equity debt in this equation?
Private equity is kind of like similar to things that we talked about in the beginning. I mean, a lot of times there are less restrictions on there. A lot of times,
Mhm.
private money comes with a lot of help. There's private equity companies that are very good at growing and scaling businesses, as they specialize in specific industries or specific types of business, and they can come in. They can provide you an equity injection. They can also help provide you support from a management standpoint. It can bring in an executive management team to really help scale the business. These guys are not always buying the entire company. Sometimes they're buying portions of the company or providing debt that turns into equity at some point. But it's private money, so it's a little bit more flexible as to the way that the money's coming in. A lot of times this money is tied up for a certain period of time. It's usually, the investors that are investing typically can't pull their money out right away. They have it locked up for a period of time, say 3 to 5 years, sometimes 7 years. And it's an interesting way to go. And you have a smaller group of private investors putting money into the business that hopefully have some influence and can help grow the business.
And generally that's some of our extras here. I want to throw in one more, and we'll just cover it real quick, kind of a derivative of what we've talked about earlier. But one option that I've seen on a handful of occasions is factoring, specifically accounts receivable factoring. Why would somebody want to consider that? And I say factoring real quick. Let's talk about account receivable factoring. Somebody would use that to basically have somebody buy a portion of their receivables, basically a cash advance on their receivables. Sure. That then the factoring company will then turn around and collect on and sell at a price. Why is that a consideration?
Yeah. So at a real basic level, like you said, factoring is, I have this accounts receivable. I sold a product. I've got an accounts receivable in my hand. Let's say it's for $1 million. I'll go to a factoring firm, which I've kind of already talked to and kind of made pre-arrangements, and then I'll go and I'll sell it to them for $940,000. So I get my money right away. Okay, I'm getting my money right away, and I can use that and then in my working capital cycle. And then that company the factoring company is going to go collect that $1 million from my vendor, and that's where they're going to get their profit. That's the most basic kind of how factoring works. There's tweaks and nuances to different types of situations and deals, and depending how qualified they are. But the real thing is you're shortening your capital cycle significantly, but it's going to have a cost. And generally it's very expensive. It's burdensome, and so that's why people don't like to do it as much. And then there's also some stigma. Some people really don't like the idea of a third party collecting their debt. They don't like an idea of their customers knowing that they're financing that way, because it's I guess more prestigious, more long-term company that's been in business a long time. A lot of those guys don't do it because they have bank financing in place. But if you need your money now, it could be a good option for you, but it's expensive generally. But there's that stigma of somebody else like collecting on your debt for you.
Right.
I don't know, what kind of thoughts do you have on factoring?
No, I agree. But at the same time, so when I think of factoring, I think of the working capital cycle, right? So the time it takes to create a product, sell a product, have a receivable, collect that receivable, and start the process over again, right? That's generally the working capital cycle. Factoring, especially early on, albeit expensive, it is an option to assist, because you want your working capital cycles to go as quickly as possible, right? Because that's how you generate revenue. That's how you grow. For companies, I've seen that can't necessarily qualify for a line of credit, or at least not the size of line of credit that they need. It is an option, and it's something certainly early on that can be considered, but it's definitely another tool in the bag to help you turn around that working capital cycle and continue to generate.
Yeah. I mean, one thing I would say on the factoring is, sometimes people think that they can, because they're selling their receivable, they can just go out and sell it. Like it's like some trading commodity. It's not that simple. I mean, you have to still go through a credit underwriting process. The factor is still going to look at your accounts receivable, and they are going to come to the determination of kind of what they're going to charge, all that kind of stuff. So you need to kind of have the arrangement in place, but at the end of the day, you're actually selling your receivable, and then somebody else is collecting it. You're selling your receivable for a discount, and somebody else is collecting it. One more thing I wanted to talk about as far as capital goes, and this is kind of further down the line. This is kind of what people kind of think of when they really want to get rich, and which I hope most of you guys can get to at some point, is that's like the IPO, or accessing the public markets for funding. A lot of clients don't get to this point, but it's something that's interesting and to have in the back of your mind that one day, maybe as an aspiration, that's what you'll do. And that's basically at some point you're going to sell your business or get money from the public market. So when you get to a certain amount of scale, reliability and income, things like that, you're going to get to a point where then you can go out to the public markets and say, here, I'm putting my company for sale. Here are the shares. And you actually can bring in money that way by selling publicly to the capital markets.
I agree. It's a great way. I would like to have an IPO myself one day. So we'll see if we can get there.
Yeah. And that's how a lot of these guys cash out, So it's a great idea, and that's when you get to put the company in your 401k, is when it's out in those public markets.
Absolutely.
But
I think that about wraps it up. I hope everyone enjoyed the show today. And certainly, I think there's takeaways from this podcast where we'll get a little bit more granular on some of the more important and generally used topics. But this was a very broad spectrum. As always, we'd love to take suggestions and hear from you on anything else you'd like to hear up as a follow-up. This has been Besim and Adam. We really appreciate the time, and we'll see you on the next one.
thanks, guys.